I'm sorry, Wendy, can I interrupt you? I think you're muted.
Sorry, thank you for the reminder. Can everyone hear me now?
Yes.
Thank you everyone for coming in. Sorry for a little bit hassle. I was trying to mute everyone, but finally mute myself. So this, just to let you know, this session is actually recorded. So if you miss any of the key important parts, you can always refer back to the video. And the CPD points will be like a uh, given to you after you request it. So after session, I will explain how the details of how you can get to CPD points, and I just happily welcome everyone coming on board. This session is about fixed income, and it's hosted by the CPA discussion group called Investment Strategies. I'm pretty sure a lot of the attendees is actually our old friends, and but this session, this CPA discussion group, called Investment Strategy, has really long history actually, for around 10 years, but it's become quite a little bit quiet after the COVID session. So I'm trying to get it back, and I'm very excited to invite our guest speaker today. It's Xiang Chua. He's from the New Palma. So I'll just read some of the introduction about Xiang. He's a senior financial advisor in the New Palma Securities in Sydney, and he actually focuses on managing wealth for wealthy families using some creative strategies and personalized investments. And Xiang has like over 17 years of experience in advising various areas in the financial planning area, and he's very experienced in SMSF, family trust, companies, and estates. Xiang is also very experienced in handling asset allocation analysis, and as a part of the Palm the Netwealth Palma Security, the company's investment committee. And he also holds a Chartered Financial Analysis certification, which is CFA, as well as a Certified Financial Planner, which is a CFP certification. And that's just a very brief introduction about Xiang, and I'm very excited to bring Xiang onto this session to share his very extensive knowledge in investments. So I'll hand over to Xiang, and I will open also a Q&A session. So everyone, when you hear a lot of things Xiang will talk about today, and just feel free to type in your questions, and we will discuss about your questions later. Thank you.
Thank you, Wendy, for the very kind introduction. I might also add that my company, New Palma, has been advising clients since 1983 for over 40 years. We advise 330 families and manage $880 million of their investments. Before I begin, I would like to say that it is a privilege to present to CPA members. I thank all of you for your time this evening, and I hope this will be an informative and useful session for all of you. The topic for today is fixed income investments, the changing investment landscape, and investment opportunities. Using my experience as a financial advisor, I will link the theory of fixed income investments with the practical implementation to create portfolios with fixed income investments. Before we start, an important disclaimer as shown on the screen. In particular, I wish to highlight that we will be providing general information only without taking into account any particular person's objectives, financial situation, or needs. Before acting on the information, please consider the appropriateness of the information, and you should obtain professional advice before acting on the information. The presentation may contain forward-looking statements, and they are not guarantees of future performance. And lastly, past performance is not an indication of future performance. My presentation today will be in 3 parts. The first section is a quick overview to explain that almost all investments can be categorized as either debt or equity. The second section goes through traditional fixed income investments such as term deposits and government bonds. The third section lays out the changing investment landscape for fixed income investments and how contemporary fixed income investments can both complement and diversify portfolios. Throughout this presentation, I may use the terms debt or fixed income or bonds interchangeably. The wider term is debt investments or fixed income investments, with bonds being a subset of fixed income investments. At the end of each of the three sections, we will pause and take questions. When you will then step in and look at the questions that you have typed in on screen, and we'll have a Q&A at the end of each section. I might just add that this session is pitched at an introductory level, assuming minimal knowledge of fixed income investments. It does, however, cover some rather complex concepts when we discuss contemporary fixed income investments, and perhaps we can have a future session to dive deeper if there is interest from CPA members. So let's begin. So with a CPA audience today, I will start with something that should be familiar with all of you. This is a balance sheet of a company. A company's funding comprises short-term loans, as you can see on screen, long-term debt, and equity. There are no other ways to fund a company. If a company needs more funds for its operations, it will either have to borrow from a lender or sell shares. As you may know, the main distinction between debt finance and equity finance is whether a part ownership of the business is given in exchange for money. Under debt finance, the owner retains full ownership. However, there are interest repayments and often requires collateral to raise the debt. Under equity finance, there are no debt repayments. However, the owner forfeits a portion of the business and revenue to the new shareholder. The table shows the advantages and disadvantages of debt finance and equity finance. At the end of the day, most companies use both debt finance and equity finance to raise funds for its operations. The proportion of debt and equity finance will be determined by the company, taking into account various factors. This slide shows how debt and equity investments translates into investment portfolios with different risk profiles. A typical conservative, balanced, or growth investment portfolio will contain debt and equity investments. Under the strategic asset allocation, the equity investments are Australian equity, international equity, and property and infrastructure. The debt investments are Australian fixed interest and international fixed interest. This shows that debt and equity investments are the building blocks of portfolios. It is the proportion of debt and equity that is different for a conservative portfolio or balanced or growth portfolio. Bonds are a very important part of the investment landscape. The global bond market is 3 times the size of global listed equities. There are about 58,200 listed companies globally and 515,000 corporate bonds. Once you include government bonds, notes, and asset-backed securities, there are over 1 million different securities. This demonstrates both the size of the bond market, which is 3 times the market capitalization of the equity market, and the number of debt investments. As an example, the Commonwealth Bank has only one class of listed ordinary share, but it has issued many different bonds both domestically and internationally, and it would easily be more than 30 different Commonwealth Bank bonds that are currently available. Let's look at the features of debt or fixed income investments. The first one is capital preservation. Unlike equities, fixed income investments like government bonds all corporate bonds have to repay principal at a specific date or at maturity. This makes bonds appealing to investors who do not want to risk losing capital, or those that must meet a liability at a particular time in the future. In contrast, equity investments do not have capital preservation as a feature, and equity investors must sell the shares at the prevailing price, which can be higher or lower than the initial purchase price. The second feature is volatility. Fixed income investments are less volatile than equity investments. This defensive characteristic is important for portfolio stability. And lastly, income. Most fixed income investments provide the investor with a predictable stream of cash flows. On a set schedule, whether quarterly or twice a year or annually, the issuer sends the debt holder an interest payment. As shown on screen, there's initial investment in the fixed income investment in year 0, followed by regular interest payments before capital is repaid to the investor when the fixed income investment matures. Stocks can also provide income through dividend payments, but companies make dividend payments at their discretion, whilst fixed income issuers are obliged to make coupon payments. This makes dividends a less predictable stream of cash flows compared to fixed income investments. As given in my previous example of Commonwealth Bank, a single company can issue many different fixed income investments with different interest rates, different maturity dates, and different priority of repayment in the event of liquidation of the company. This shows that it is not a homogeneous market with different issuers and different reasons for raising funds. One important difference compared to the listed equity market is that fixed income investments trade on the over-the-counter market, or the OTC market. Buyers and sellers either directly deal with each other or via broker. There is no centralized market for fixed income investments. It is a diverse, dispersed, and differentiated market. It requires specialists and in-depth knowledge to navigate the complexity of the bond market. So far, I've laid out the broad differences between debt and equity to set the scene that investors either invest in debt or equity. I have also laid out the important features of fixed income investments, including preservation of capital, lower volatility compared to equities, and a predictable stream of cash flows. This is the end of the first section of my first 3 sections. It's a broad introduction to debt versus equity. And I'll now pause to take questions, and Wenny will, I think, facilitate this session. So over to you, Wenny. Thank you.
Oh, thank you, Xian. So far, sorry for that, because I got some issue with my Q&A bot, but so I can see that there are 2 questions coming up. And the first one is that from Zoe. It says, we can view Aussie equity market via iAccess, where to view the latest Australian bond market movements.
That's a great question, and this is the slide that I have on screen. Bonds or fixed income investments are not usually listed and trade on the over-the-counter market. It is an opaque market where there's no centralized screen. What normally happens to trade a bond, a broker will contact other brokers out in the market, and then on their Bloomberg screen, they may disclose some prices, and then the traders will then proceed with the trade. So there's no centralized reporting on a daily basis. What brokers do in this instance is record the last traded price, and they may internally have their own records of what the price should be. So it is a willing seller, willing buyer sort of market with no centralized market. And it's understandable because it is, as I said on this screen, it is very diverse. There's so many different bonds and and issued by so many different companies, and hence it is just it is on the over-the-counter market. I hope this answers the question, Zoe. And Winnie, I think there's the next question, is there?
Oh yeah. There's another one is if the company pay bond dividends at discretion. I think that's what you just mentioned, and it says how do we know in advance?
Usually, unlike a dividend is a discretion of the company. The company's directors, at the end of maybe each quarter or each half year or at the end of financial year, declare a dividend based on the outlook of the company, the funds available, and that's at the discretion of the company. In contrast, for a bond, it is like a contract. When you sign up for a bond, there are predictable repayments that are required in terms of interest repayments. And if in the next section, I'll go through that in more detail, and you can see that it's like a contract saying every 6 months this amount has to be paid. Otherwise, the bond goes into default, and there will be repercussions whether then the bond has to be repaid in full because it's gone to default, for example. Hope that answers the second question as well, but thank you. I can see your response, but we'll go into greater detail in the next section. So that's great. Winnie, there are no further questions. I'll continue, and great second question because this segues in my next section. So my next section, this second section will cover traditional fixed income investments. One very simple example is term deposits, which are basic and straightforward form of fixed income investment. The interest rate is usually known up front, and there is a government guarantee of up to $250,000, which provides security. Investors are attracted by its high security and ease of investment. Moving on to government bonds and corporate bonds. The use of the word bond in this setting refers to an instrument binding one to pay a sum to another. And this dates back from at least the 1590s, more than 400 years ago. So bonds as a concept has been around for hundreds of years. And let me talk about government bonds. And the government bond sector is a broad category that includes sovereign debt, which is issued and generally backed by a central government. So backed governments such as the Canadian bonds, the US Treasury, or Japanese government bonds. They are all examples of sovereign government bonds. The US, Japan, and Europe have historically been the biggest issuers in the government bond market. After the government sector, corporate bonds have historically been the largest segment of the bond market. Corporations borrow money in the bond market to expand operations or fund new business ventures. Corporate bonds fall into two broad categories: investment grade and speculative grade. Let's start again. Corporate bonds fall into two broad categories: investment grade and speculative grade, also known as high yield or junk bonds. Speculative grade bonds are usually issued by companies perceived to have lower credit quality and a higher default risk than more highly rated investment grade companies. Within these two broad categories, corporate bonds have a wide range of ratings, reflecting the fact that the financial health of issuers can vary significantly. Speculative grade bonds tend to be issued by newer companies in particularly competitive or volatile sectors, or companies with troubling fundamentals. Whilst a speculative grade credit rating indicates a higher default probability, higher coupons or high interest rates on these bonds aim to compensate investors for the higher risk. Ratings can be downgraded if the credit quality of the issuer deteriorates or upgrades if fundamentals improve. So these are the three types of traditional fixed income investments. We've got term deposits, government bonds, and corporate bonds. So there's one here from the archives. This is an Australian Treasury bond issued in 1966. It's a bond with a $20 face value with a fixed interest rate of 5.25% and a term of 21 years. Let me read to you the wordings on the bond, and it has important information on how much the bond will pay, when it will mature, and the security for the bond. So let me read it out. This bond entitles the bearer of payment. Let's start again. This bond entitles the bearer the payment at the Reserve Bank of Australia at Canberra, Sydney, Melbourne, Brisbane, Adelaide, Perth, Hobart, or Launceston of $20, together with interest therein at the rate of 5.25% per annum in accordance with attached coupons, and such sums are secured on the consolidated revenue of the Commonwealth of Australia. Principal is repayable on the 15th day of November 1987, dated 14 February 1966. So straight away, we can see there's a face value, $20. We know the return, 5.25% for the next 21 years. We know that it is secured on the consolidated revenue of the Commonwealth of Australia. So it's guaranteed by the Commonwealth. A bit of history there. And I think this answers the second question that we had in the previous section in a way. So you can see it's like a contract. It's written up there very, very clearly. So the three important things to consider for government bonds and corporate bonds are, number one, who's the issuer and the credit rating of the bond. We can contrast between an issuer like the Australian government, which is AAA rated, or a small company, which does not have a credit rating. The risks are very different between these two issuers. The second point is the term or the length of the investment is also important. A short term of, say, 1 to 3 years has a lower risk compared to a longer term of 10 years. And the other feature, or the third feature that we should look at, is the interest rate on the bonds. It can be fixed throughout the term of the bond, or it can be floating rate. I will explain this in detail later. Coming back to credit ratings, credit rating, what is it? It is an opinion about the ability and willingness of the issuer to meet its financial obligations. So let's look at AAA right at the top. It says extremely strong capacity to meet financial commitments, highest rating. In contrast, BBB, which is towards the bottom end of the investment grade range of bonds, so the middle of the table, it says adequate capacity to meet financial commitments, but more subject to adverse economic conditions. Now let's look at a speculative grade bond, CC, which is the third row from the bottom. It says highly vulnerable. Default has not yet occurred, but is expected to be a virtual certainty. Please note that in Australia, credit ratings are generally only available to wholesale investors. And this is because of licensing requirements. So let's talk a bit. I just saw Mickey's question. Since we are talking about rating agencies, the three main ones are S&P, Fitch, and Moody's. And those are global sort of investment rating agencies. and they rate various government bonds and corporate bonds. On fixed rate bonds, the coupon or interest rate is fixed. The price and yield move inversely, so in opposite directions. In other words, a bond's price always moves in the opposite direction of its yield as shown. The key to understanding this critical feature of the bond market is to recognize that a bond's price reflects the value of the income that it provides through its regular coupon interest payments. When prevailing interest rates fall, older existing bonds of all types become more valuable because they were sold in a higher interest rate environment and therefore have higher coupons. Investors holding older bonds can charge a premium to sell them on the market, on the secondary market. On the other hand, if interest rates rise, older bonds may become less valuable because their coupons or interest payments are relatively low, and older bonds therefore trade at a discount. So this is about fixed rate bonds and the inverse relationship between the price and yield. To demonstrate the inverse relationship between price and yield for fixed rate bonds, let's use this more recent example of an Australian Treasury bond. The bond was issued in May 2020, and as always knew, that was during COVID. The interest rate is 1% per annum with a maturity of 10 years. So an investor that invested in this bond will receive 1% per annum from 2020 to 2030 with a maturity in December 2030. A 10% total return over 10 years. When interest rates subsequently rose in 2022 and 2023, this bond's trading price would have fallen over 20%. So this clearly demonstrates the relationship or the inverse relationship between price and yield. In contrast to fixed rate bonds, floating rate bonds operate differently. For floating rate bonds, the interest rate is the sum of a variable external reference rate and a fixed spread or margin. The external variable reference rate could be LIBOR, which is the London Interbank Offer Rate, US Treasury rates, or in Australia, we normally use the bank bill swap rate or interbank rate. This normally moves with prevailing interest rates. In other words, if interest rates rise, the bank bill swap rate in Australia should rise in tandem. The fixed spread or margin, which is the other part of the equation, reflects the risk of the bond. With a higher margin for bonds, with a lower credit rating. So bonds with lower credit rating usually have a higher margin. And on the opposite side, if it's a high credit rating, the margin is usually lower. So just use an example. Currently, the BBS swap rate in Australia might be around, let's say, around 4.5%. So that's the variable external reference rate. So that moves up and down with the cash rate. This fixed spread could be 1%, could be 2%, could be 3%. So we've got 4.5% plus 1, 2, or 3. And if the cash rate comes down, let's say it comes down to 3, the bank bill swap rate might come to somewhere around, let's say 3.5. So we've got 3.5 plus 1, 2, or 3. And you can see how the return changes over time in line with the external reference rate. So let's look at current yields of traditional fixed income investments. We've got the cash rate 4.35%. Maybe one of the best rates you can get currently for term deposits, that's 4.85. And a 10-year Australian Treasury bond would be about 4.65. And for corporate bonds, it really varies. It could be anywhere, let's say, for an investment grade company, it could be somewhere around 4 and 5%, and more speculative might be much higher. So it really varies depending on the credit rating of the company. And for investors, can they access these investments? For retail investors, they can access term deposits, managed funds, and ETFs or exchange traded funds on the ASX, listed on the ASX. For wholesale investors, their range of investments are much broader. They've got term deposits, obviously, managed funds and ETFs, and direct ownership of government bonds and corporate bonds. In this example, managed funds and ETFs might invest in government bonds and corporate bonds, and this is how retail investors can access these investments. So let's look at how these investments have performed over the last couple of years. One traditional reason to invest in bonds is that they are defensive and preserve capital. However, this did not happen in 2021 and 2022. As the cash rate increased from 0.1% in 2021 to over 4% by 2023, there was enormous damage done to bond values, with negative returns about 3% in 2021 and a further negative return of 10% in 2022. There was minimal diversification benefit for investing in bonds, because in calendar year 2021, the ASX 200 fell 1.1%, and international equities also fell by 16.8%. So if you had a portfolio that had both shares, Aussie shares, international shares, as well as bonds, all segments fell in 2021. I should point out that with high interest rates now, it is less likely for government bonds or corporate bonds to have a negative return for a year. This is because the ongoing yield or income is higher and can offset some capital losses in bonds. I'm sharing with you this screen is instructive. We can compare at the top row the RBA cash rate. We can see how historically it's moved. Do bear in mind the numbers here on the RBA cash rate does include reinvestment of income for the year. Hence, for 2025, with reinvestment income, it comes up to about 4.5%. But you can see pre-COVID, the cash rates was quite low in 2019 at 1.2%, in 2018 at 1.5%, and thereabouts for a couple of years before that. And bonds did have a slightly higher return compared to the cash rates for those couple of years, a couple percent higher. So they did perform a role in portfolios giving a higher return. However, as noted here on screen, by 2021 and 2022, when rates dropped to almost zero and the bond yields became almost zero, then any interest rate rises impacted bonds significantly. Remember the inverse relationship that I talked about previously. So what are the risks of traditional fixed income investments? Interest rate or duration risk. This is exactly the risk that I've just talked about. As previously mentioned, bond investments are sensitive to movements in domestic and international interest rates, and the magnitude or the size of this risk is measured by duration. The level of duration is therefore an important aspect to consider when investing in a bond or portfolio of bonds. The other important consideration or risk is the possibility or is credit or default risk. This is the possibility that a bond issuer will default, and that means that the issuer will be unable to make interest or principal repayments when they are due. Bonds issued by government or government agencies or government-sponsored agencies are less likely to suffer from default due to their ability to raise taxes. In comparison, bonds issued by corporations, particularly high-yield bonds, have a higher probability of default. The other risk is liquidity risk. There is a probability of loss arising from the difficulty of selling an asset because of insufficient buyers or sellers in the open market. An investment may sometimes need to be sold quickly. Unfortunately, an insufficient secondary market may prevent the liquidation or limit the funds that can be generated from the asset. Liquidity risk may be quantified as the difference between an asset's value and the price at which it can likely be sold. To manage liquidity risk, investors can consider investing in higher quality investments or assets such as government bonds or investment grade bonds. I'll pause now because we've come to the end on the second question, second section, and we'll open up for questions. Over to you, Wendy, please.
Yeah, I can see there are many questions. Let's go one by one.
Thank
The
you.
first one is from Maven. The question is this the reason why speculative bonds are measured at fair value through profit or loss as per AASB 9 as they are held for trading purposes?
Um, that's a very great question, and it is more a tax accounting question, and I'm unfortunately not qualified to answer that because I'm more of a financial advisor rather than a tax accountant. Maybe Wendy, maybe are you able to shed some light on that, please?
Oh, I'm not accountant either, although I hold a CPA. Um, I do not know really about this answer either. But I do, if Maven is interested, I can post to this question to the accountant in my company, and later I can send you an email regarding this question if that's what you want.
It's a great question. Yes.
Yeah, yeah, yeah. I'll mark this down. And the second question, let's go by the second question. That's by Mickey. What's the major credit rating agencies doing rates on bonds?
There are three major global ones: S&P or Standard and Poor's, Fitch, which is FITCH, and Moody's. So these are the three various credit rating agencies that go about rating various bonds throughout globally or throughout the world.
Yeah. So I think the next question is actually related to this one too, because you mentioned, I think, if credit rating is only available to wholesale clients, how do we know what is the best for us individual investors?
There are other things that individual investors can look at. They can always look at the issuer. That will be the key thing to look at. If the issuer is the Commonwealth Bank of Australia, that is a very different credit risk compared to a smaller company. So the key thing I would suggest is to look at the credit issuer. And if you're inclined, being this is a CPA audience, look at the balance sheet of the company as well. Look at its assets, look at its liabilities, and you can have a good feel of the company's strength there in the balance sheet. And also look at the profit and loss statement. It will show the cash flows of the company, how much profits it's making, and the key metric that many bond investors use is, again, going beyond the scope of today's presentation, is something called interest cover. That means how many times of cash or earnings does the company have to cover the interest payments? Is it one time? If it's one time, all the earnings go to cover interest payments. And if the company's earnings fall or interest rates go up, company's in trouble. So ideally, it should be more than one time. And usually we are more comfortable it's at least three times. So these are some of the things that investors can look at. So the issuer, I would say, is the main thing to look at.
Yeah, that's good. I like those quick tips. The next one is from Mickey too. It says, in rate cut years, is it better to buy fixed rate bonds with higher yields?
In general, that's a good strategy. In the falling interest rate environment, if an investor can position themselves to buy a fixed rate bond, they will profit from an increase in the bond price whilst the interest rate starts to fall. However, the key point here, it is a few things. One is you need to position yourself because markets can look ahead in what's the RBA likely to do, for example. So that's one thing. So you need to position for that, which can be tricky. It is almost like market timing, in which is very, very difficult or almost impossible. That's the first point. But the second point is also this, which is exactly what I said, is market timing and the
Right.
difficulty of it.
And that's why we need financial advisors sometimes because they keep
Thank you.
track of the market. Yeah. And next one is by someone anonymous. It says, what will happen to corporate bonds when the company goes into liquidation?
Again, a fantastic question, and I love the questions that always lead to the next section. Um, because what we'll need to look at is the capital structure of the company or the corporation. Because the capital structure will determine the priority of repayments in the event of liquidation. As we all know, shareholders are the last in line, but bond investors usually rank higher than shareholders. But it depends on the bond. It can be a higher ranking senior bond, or it can be a lower ranking subordinated bond, and that will determine the priority of repayments. But what I would say in general is look at the priority of the bond. High ranking bonds will get paid first, and then only if there are funds left over, the lower ranking bonds get paid, and then finally the shareholders.
Right. Yeah, that's for all the questions for so far.
Okay. We'll move on to the third section, and which is contemporary, or what I call contemporary fixed interest investments. Moving on to our third and final segment is contemporary fixed interest investments. Contemporary fixed interest investments include bank securities, loans, asset-backed securities, and debt warehouse facilities. We will go through each of them in detail in the following slides. We'll talk about bank securities later in the following slides, but I just wanted to explain a bit about mortgage-backed securities and asset-backed securities. This is another major area of the global bond market, and it comes from a process known as securitization. Again, this will be explained in later slides, in which the cash flows from various types of loans, such as mortgage payments, home loan repayments, in other words, car payments or credit card payments, for example, are bundled together and resold to investors as bonds. Mortgage-backed securities and asset-backed securities are the largest sectors involving securitizations. These bonds are created for mortgage payments from residential homeowners. Mortgage lenders, typically banks, sell individual mortgage loans to another entity that bundles those loans into security that pays an interest rate similar to the interest rate paid by the homeowners. As with other bonds, mortgage-backed securities are sensitive to changes in prevailing interest rates and can decline in value when interest rates rise. Securities backed by fixed rate mortgages in particular are sensitive to interest rates because borrowers can prepay and refinance their mortgages when rates drop, causing securities backed by these loans to pay earlier than expected. Asset-backed securities, these are securities backed by credit card payments, car payments, or other loan payments. As with mortgage-backed securities, similar loans are bundled together and packaged as a security or bond that is then sold to investors. Well, Driving all this contemporary fixed interest investments is the rise of what we call the rise of private credit. Following increased regulations on banks post-GFC, banks have pulled back from lending in many sectors. This has allowed non-bank lenders to step in. Private credit includes categories of loans, asset-backed securities, and debt warehouse facilities. From less than $50 billion in funds under management in 2015, Australian private credit, also known as private debt, has posted a compound annual growth rate of 23% per annum since then, to reach almost 200 billion in 2023 and would have surpassed 200 billion by the end of last year, 2024. So this is an important, I would say, development in the fixed income market or fixed interest market, where non-bank lenders and the rise of bank credit has provided a greater range of investment opportunities for investors. And private credit funds attract investors with a carrot of high returns and lend their money to borrowers. Banks also lend to borrowers. But what's the difference? The difference is that the bank assumes the risk of default, not the depositor. However, in private credit, it is the investor who assumes the default risk, and this is a major difference. This higher risk is the reason private credit normally pays a return that exceeds the risk-free rate that the depositor could get, for example, a term deposit. So I'm drawing a distinction between a term deposit, which is government guaranteed, usually if it's under $250,000, and it pays and the security on that. In contrast, private credit, if it loans money to a company that defaults, the investor in the private credit does take on the risk of the loss of capital. Those that seek private credit financing sometimes fall outside bank risk limits and have grown in number as banks are subject to increasingly stringent lending regulations. At the end of last section, I had a question about ranking and repayments and compared to shares. So this is the capital structure that's important to look at. So back to bank securities, we first need to understand the bank's capital structure. The chart shows the capital structure for a major bank with equities or shares sitting below the debt. At the bottom of the capital structure is the bank's ordinary shares. Going up the capital structure, hybrids rank higher than shares, with subordinated debt, senior unsecured debt ranking higher than hybrids. The capital structure is important to know because should a bank or a corporate default or proceed into administration, receivership, or liquidation, then it is this structure that will determine the priority of which investors receive their funds back first and who will have losses applied first. The higher up the capital structure the debt sits, the more secured investments. However, even senior secured bondholders can receive less than their original principal investment back in an extreme default scenario or where the business has been poorly managed. The position in the capital structure will also determine the rate of return an investor can potentially receive from the issuer. With the higher up the structure, the lower the applicable interest rate. This is due to the lower perceived risk of the investment principal suffering loss. The reverse is also true where an investor who is comfortable with the overall or underlying risk of the issuer is happy to sit lower on the capital structure in order to receive an enhanced return on the investment. So in practical terms, back to my Commonwealth Bank example, we know the Commonwealth Bank is one of the top 10 companies in Australia, very profitable, and has got very well managed and has long track history. Investors are very happy to hold the hybrids, which is one of the lowest ranking debt investments there, as you can see on the bank capital structure. In contrast, if it's a smaller company, even if you hold a senior secured debt right at the top of the capital structure, if the security is weak, there's less likelihood that you'll receive your money in the event of liquidation. Hence, back to the first point that I did raise earlier, look at the issuer first, and that's the key thing to look at. Then it comes where it ranks within the capital structure. Besides the capital structure, another important concept is credit spread. We had discussed spread or margin earlier in relation to floating rate bonds, and this is referred to the additional return above the external reference rate. It is a similar concept to credit spread. Credit spread is the different yield between two bonds with similar maturities but different credit qualities. It measures the additional yield that investors demand for holding a bond with a higher credit risk compared to a safe bond, such as a government bond. The chart on screen shows the changing credit spread of US investment-grade corporate bonds. Spreads now are at historically tight or low levels. Looking at the chart, we can see credit spreads widen tremendously in 2008 during the GFC, where spreads widened from sub 100 basis points of less than 1% to over 6%. The next peak was, you can see in early COVID in 2020 as well. Note again, this is not the outright interest rate, but it's just a spread. So to get the interest rate on the bond, you would need to add the external reference rate to the spread. And as we know, the external reference rate is usually a floating rate. It could be something like the bank bill swap rate, which moves with the RBA cash rate. And I'll have charts later to show this as well. So back to bank securities. We showed the bank capital structure. Just now we've got the hybrids, which is also known as AT1s or additional tier 1 securities. Above hybrids, we've got tier 2 bonds, or also known as subordinated bonds. And above that, we have senior unsecured bonds. So we have three types of bank securities in different parts of the bank capital structure. We can see that small spreads for bonds high in the capital structure. Again, if you look towards the right of the chart, spreads have now tightened compared to their historical range. Once the external reference rate is considered, and in this case, it is the bank bill swap rate, the running yields look very different to the spread. With interest rates rising from 2022, the running yields from bank bonds have increased from the lows in 2020 and 2021. We now have senior bank bonds yielding about 5% and tier 2 bank bonds yielding about 6%. These are healthy returns for investment grade bonds. For bank hybrids, the yields are even higher at around 6%. Whilst the 6% yield may appear healthy, the spread for hybrids is currently tight compared to historical levels, and some investors do not see much value in them compared to the alternatives in higher ranking securities. This was demonstrated in the chart a few slides ago showing spreads. Due to the overseas experience, such as writing down to zero value for Credit Suisse hybrid securities, the local regulator has now decided to phase out the $43 billion market of bank hybrids by 2032. This is a significant change to the fixed interest market, especially for retail investors. As we know, hybrids are one of the few investments that retail investors can buy directly on the ASX. Hybrids are listed on the ASX, whereas the higher ranking securities, the tier 2 bonds, as well as the senior bonds, those trade on the over-the-counter market and only available to wholesale investors directly. The other part on contemporary fixed interest investments, let's look at bonds versus loans and what the differences are. They are mainly similar, but the one main difference is that bonds are traded on the market, on the bond market, whereas in contrast, loans are less liquid as there is no loan market for trading loans. Another way to look at it is bonds are like securities that we mentioned earlier, securitized. So they're bonds that can be bought and sold. Loans are more bilateral, meaning it is between a lender, usually a bank, and the borrower. Notwithstanding that, loans can still be accessed via managed funds and ETFs. Both retail and wholesale investors can access it. However, to access individual loans directly as an investment, it is more challenging. However, notwithstanding that, loans can also be an attractive investment, provided the risks are understood. So let me share with you a direct loan example that we have brought to our clients. It is an ASX 200 listed company and had to raise cash to refinance existing debt and also fund its development commitments. The interest rate of 13.5% is obviously attractive, but also obviously reflects the impaired nature of the company's cash flow. It was the security provided for the loan that made this attractive. The company owns prime real estate in various cities in Australia, and this loan is senior secured over the real estate. Importantly, this loan has major banks participating, and all investors in the loan, whether they are a bank or an individual wholesale investor, are part of the same loan. Overall, we are comfortable with the risk and return for this loan investment. I've mentioned at the start of this third section about asset-backed securities. So let me walk you through the process. What is securitization and how does it come about? So the first step, a lender issues loans to individuals or corporates. The lender could be a bank, and the loans become an asset on the lender's balance sheet. So that's the first step. The next step, the lender then sells the loan assets to a SPV or special purpose vehicle. The SPV then issues debt, dividing up the benefits and risk among investors. Hence, all the individual loans that are sold to SPV are now divided up and resold as debt. The SPV packages them into asset-backed securities, and they are typically structured into various classes of tranches, and the asset-backed securities are then sold to the public in the capital market. Again, this will be likely traded in the OTC or over-the-counter market. Let me give you a different perspective of the exact same concept here again. In this example, we have a pool of mortgage securities on the or mortgage loans rather. On the left side, these loans are securitized into different tranches, varying from AAA rated securities at the top to unrated securities at the bottom. The loss position, credit risk, and yields are inversely related as shown. The higher the risk of loss, the higher the expected yield. Another contemporary fixed interest investment is debt warehouse facilities. Non-bank lenders need to have funding to write their loans. The funding is provided via a warehouse facility. Let's walk through the process. We have the ABS warehouse or asset-backed security warehouse in the middle. To fund the warehouse facility, banks and non-bank lenders provide a loan to the warehouse. From the warehouse facility, the non-bank lender writes loans to consumers and corporates on the right. In this scenario, a fixed interest investor earns a return by providing a loan to the warehouse facility that is used by the non-bank lender. I do appreciate this can appear a rather complex concept, so maybe I'll just walk through it again. What's happening here? We've got a non-bank lender. It could be Pepper Money or some other non-bank lenders out there in the market. In order for them to provide a home loan to borrowers, they need to have access to funding, and that funding is what's called the debt warehouse facility. That funding is usually a short-term funding facility. It might last for 2 or 3 years. So a bank steps in, and a non-bank lender might also step in. Another non-bank lender might step in to provide that short-term funding facility for 3 years. So over the 3-year period, the loans are gradually drawn down by the non-bank lender to write loans to consumers or corporates. At the end of the 3 years, all these bonds or all these loans are then securitized, packaged and securitized, and on-sold as mortgage-backed securities, as what we saw earlier. The warehouse will then shut down, and a new warehouse will then come about. And someone like Pepper Money will have another warehouse facility and start the whole process again. So this has become a very attractive vehicle for banks, because banks now have a very short window of 3 years to lend money as compared to a 30-year mortgage. In the bank's capital structure and the way they look at risk, this has now become something that they are more comfortable with. And the non-bank lender, as you can see on the left side, might provide a lower ranking sort of loan to the ABS warehouse, and that provides a higher return. To give you an example or appreciation of it, a bank on the top left might lend at RBA cash rate plus 1% as example to the ABS warehouse, whereas a non-bank lender, because it might be ranking lower, it might lend at cash rate plus 3%. And that provides the higher return for the non-bank lender. But again, back to the earlier examples, they are lower down in the structure. You can see there's senior funding, there's mezzanine funding, and then equity as well. Usually the non-bank lender might provide the mezzanine funding, and then the bank might provide the senior funding, which is the cheaper funding that I talked about. So what are the risks? The risks are previously discussed with traditional fixed interest investments, and they also apply here to private credit. In particular, there's credit or default risk, whereby the loan or fixed interest investments goes into default and may not be repaid. So that's a big risk there. There's also liquidity risk, as the fixed interest investments may not be able to be readily traded or redeemed. That's the liquidity risk. And the new one that I'm raising here is called conflicts of interest. We have seen private credit funds that raise money from investors, and the private credit fund then lends money to a related party. This conflict of interest by the private credit manager can be a serious issue if funds are deployed inappropriately. So let's look at some of the risks that have been coming up in the headlines. This is an example of credit or default risk if the initial risks are not properly assessed. I'll read some of the details in a second, but let me first stress that the private credit fund that's on screen there has said that they have not lost capital as their loans are secured against assets of the collapsed company. But it does show the potential risk, and in particular, credit risk. So in this case, we've got a major Melbourne developer that collapsed into administration owing at least $150 million to a private credit fund. That's just late last year in December 2024. And earlier this year, the same fund said that investors might have to wait 9 months to get the money back because several of the projects went bad. Well, we use a range of private credit funds across loans, asset-backed securities, and debt warehouse facilities. Returns have been strong in the past few years, as you can see on screen, and have increased in line with the RBA cash rate. In particular, private credit funds did not suffer the 10% drawdown or negative return in 2022. But I must highlight that one main trade-off for the higher return is lower liquidity. Many of these private credit funds invest in loans, asset-backed securities, or debt warehouse facilities. As I discussed just now, debt warehouse facilities usually roll over every 3 years. So once the lending is done for 3 years, it's locked in for 3 years. That's the lower liquidity I'm talking about. In assessing private credit funds, some factors to consider include size and scale of the manager. A manager needs to have a sizable team, breadth of market coverage, and borrower relationships to achieve proper diversification in private credit portfolios. The next thing to look at is track record of performance and diversification. Managers should maintain diversified portfolios to help spread the risk across sectors. Investors should look for portfolios that are diversified across borrowers and ensure the exposure to any individual borrower does not expose their capital to inappropriate concentration of credit risk. In other words, not all eggs in one basket. This has been quite a fair bit of theory. We've talked about bonds versus equities, what's the difference, and that investments in the investment world, whether it's a conservative portfolio, balanced portfolio, or a growth portfolio, have some combination of debt and equities in them. So that was the first section. The second section, I talked about traditional fixed income investments and now contemporary fixed interest investments. But that's all theory. How do we put it together from an advisor's point of view or an investor's point of view? From a financial advisor's perspective, we have to tie back the various types of investments to a purpose-inclined portfolios. As an extreme example, if a client is investing cash for a short period of time for a large tax bill, maybe private credit funds may not be appropriate. But other fixed income investments, such as a term deposit, may be more appropriate. Let me share with you our approach on portfolio construction and portfolio building blocks. The underlying philosophies are diversification and a purpose or role for each investment. So broadly, we've looked, we have asset classes. Liquidity is one, which is cash or something that's can be liquidated cash quite quickly. Then we've got debt investments, which is basically lending. And then the last one is equity, which is you're part owner of the business. To provide liquidity in investor portfolios, we can look at cash, short-dated or short-dated term deposits, and some fixed interest funds. Maybe not private credit funds, though. And there's a purpose for a client. And if you look from the client's point of view, an advisor stepping in, what's the purpose? It is to fund withdrawals, whether anticipated or not anticipated, as well as to take up investment opportunities, meaning to have the cash to buy an investment opportunity when it arises. So that's the first segment. Then the next segment is on the debt side or the lending side. We can have government bonds, we can have corporate bonds, asset-backed securities, loans, and fixed interest funds that cover all these segments. And what's the purpose there for clients or in client portfolios? It is to generate regular income and to be less volatile than equities. And the last section is equities, which is a conversation for another day, which I've not covered today. Equities can be real estate, it can be infrastructure, Aussie international shares, or private assets, meaning private companies. And why do we invest in that? To achieve capital growth in client portfolios, inflation protection over time, if there's capital growth. And generally, it does have high volatility compared to debt investments or fixed income investments. So this ties all the theory, all the traditional investments and contemporary investments into what it means for clients and how portfolios are created with a purpose. So let me pause now. I've seen quite a few questions come through, and I'm looking forward to the Q&A. So over to you, Winnie. Thank you.
Yeah, thank you, Xian. There are a lot of questions I can see. Let's go one by one. The first one is from Zoe. Bank hybrids will be phased out by 2032. What does this mean to investors?
Well, a couple of things. Existing investors are not impacted. They can continue to trade on the ASX for hybrids. They can still buy and sell. What it means is existing hybrids, as they come up to their call date or redemption date, it is likely that the banks will redeem it and not issue a new one. That means over time, the market will shrink. There'll be less and less hybrids. I expect existing hybrids to continue until their call date. The last call date or redemption date will be close to 2032. But obviously, over time, the next couple of years, it will shrink. Even in this year, 2025, a couple of hybrids are expected to be redeemed and there'll be no replacements. We expect banks to instead issue Tier 2 bonds to replace it. And as explained earlier, unfortunately, Tier 2 bonds are only available to direct wholesale investors. Otherwise, to access Tier 2 bonds, retail investors have to go through a managed fund or ETF. And what we have seen for hybrids because of this reduced supply, if I can put it that way, and I've shown you in the previous slides, the credit spreads or margins have tightened, meaning they have become more expensive. In other words, it's become less of an attractive investment compared to other investment opportunities. That's our view.
Right. And next one is from Maggie. It says, are individual investors to be able to buy mortgage-backed bonds?
In general, no. It is a very complex investment because mortgage-backed bonds or mortgage-backed securities, one needs to do a few things. One needs to look into the underlying pool of mortgages that support the bond. The pool of mortgages can be good or maybe not so good. So that will impact the risk that investor is taking. So that's one thing, the pool. Because it could be a pool of investor interest only loans, which are more likely, I would say the risk of default is higher compared to a principal residence where the owner is making principal and interest repayments. So that's one thing to look at. The pool is quite different. And then the other thing to look at is actually the bond itself. You can have higher ranking bonds and lower ranking bonds within the pool. The lower ranking bonds will be the first to take a hit if there's a default on the loan, on the underlying loans, compared to higher ranking bonds. So I would suggest retail investors go through either a ETF or something like an ETF or managed fund, because you do need professionals to look at the risk and to manage the portfolio to buy residential mortgage-backed bonds. And there are a
Yeah,
few options out there in the market. They are both listed and unlisted.
yeah, I do remember those kind of bonds, those kind
Yeah.
of securities quite famous during the GFC session. It's actually a very interesting question.
Mm.
The next one, let me check. Oh, sorry, just okay, that's from Joe. No credit rating on this direct loan. I think that's I was
Yes,
looking for
correct.
it. Yeah,
Yeah.
that was one. Yeah, says how to ensure that it's a sound investment because I see the return is 13.5%, which is quite good. Yeah.
Well, again, back to looking at the company itself. A credit rating is only an opinion by the credit rating agencies, whether it's by Standard & Poor's, Fitch, or Moody's. If we want to be rigorous as an investor, I would suggest being more thorough in the due diligence and looking at the company itself, looking at the company's balance sheet. What are the assets? Looking at the company's cash flow. What are its earnings? How variable its earnings are? Can it support the interest repayments? The example I shared, the comfort that we have is it is firstly senior, meaning it is first ranking in the event of liquidation of the company. So that's very important. So you're first in the queue. Secondly, it is secure. In this case, it is secured on the underlying assets of the company. And in this case, as I said, it owns prime real estate in the major cities in Australia. And to just give you a feel of the number, the value in the balance sheet of the real estate, we are talking over $1 billion. So these are some of the parameters that can be looked at, even though I would say, yes, it's unrated. And one reason I would say why it's unrated is actually because it's a loan. There's less need for a loan to be rated because it is not readily traded. In contrast, bonds needs to be traded on the market, and investors, you and I, might need a quick way to assess the risk, and that's where the credit rating agencies come in and say this bond is AAA rated or this bond is BB. So straight away you can get a feel of the risk without having to go through what I just talked about, the balance sheet and so on and so forth.
Let's see the next one. That's from Zoe again. Do non-bank lenders offer better rates than banks? Are their repayment methods more negotiable?
Non-bank lenders, sorry, could you repeat that? Non-bank lenders, Wenny?
Do non-bank lenders offer better rates than banks? And are their repayment methods more negotiable?
Okay, I'm not sure whether this is coming from the perspective of a borrower or an investor, because it's
That's
quite
true.
different. It's
Yeah.
quite different. Let's cover them one by one. From a borrower point of view, someone like you and I, whether we borrow from Commonwealth Bank or a non-bank lender, potentially I would say a non-bank lender might be more flexible.
Mm-hmm.
Typically, my understanding is a non-bank lender may not be bound by some government regulations in terms of looking at credit risk of the borrower. Hence, they're more flexible, meaning they may be willing to take a high risk for a borrower, but in return, likely the interest rate the non-bank lender would charge on the loan would be higher. So
Mm-hmm.
that's from the borrower point of view. Um, from investor point of view, it is more back to what I was referring to again. We don't invest directly into a non-bank lender per se, but via maybe the debt warehouse facility that I talked about earlier, or they could issue a mortgage-backed security. And in those scenarios, again, it's back down to what is the underlying pool of the assets and so on and so forth that supports it. Whether it's, as I said, investor loans or principal residence loans, the risks are different there. So again, I would suggest look for well-run managed funds that have professionals that can understand the risk and in the market to make the appropriate investment decisions.
Yeah,
Mm,
it's always that.
mm.
And next one is from someone anonymous, saying what type of assets are generally secured with asset-backed securities? And second question is, are asset-backed securities generally considered lower risk than mortgage-backed securities?
Okay. Asset-backed securities is just a wider term.
All right.
Mortgages can be one of the assets or loans, but it's a wider term. It can include um, credit cards, credit card loans. It can include car loans, or it can include equipment finance loans. So all different types of loans, any type of loans you can think out there in the market, uh, the underlying loan will become the asset that can be invested against. So that's the asset-backed security. And in terms of returns, again, it's just back to the risk. I would argue that in general, especially in the Australian market, residential backed securities are one of the lowest risk. Because if you look at a typical borrower, when they borrow from either a bank or non-bank lender, they will have to provide the house as security. And
Mhm.
that's and in the Australian context, residential real estate is quite a solid security to provide. In contrast, if the underlying assets are equipment or cars, and we do know that's usually more a depreciating asset, so the risk profile is slightly different there. And
Right.
and the other extreme example, another example is credit cards. Um, that yes, it's an asset which is a credit card loan, but behind that there are no physical assets behind it. So I would argue that risks there are higher.
Yeah,
But
definitely.
again, yeah, but again, fund managers can assess the risk looking at the various assets underlying the asset-backed security. And package them into appropriate investments with different types of risk for investors.
Right. So talking about this, just suddenly come to me.
Yes.
If investors like literally they need to buy some different kind of asset-backed investments, for example,
Mm,
ETF or managed
mm,
fund, like you mentioned,
mm-hmm,
when they look at those like PDS, the product disclosure statement, they
mm,
actually can find exactly what type of assets are backed by different kind of like ETF. Is that right?
exactly.
Mm. Yeah. So,
A PDS should explain the investment strategy of the fund. In other words, it should explain this is what we invest in.
mhm.
It should also explain what the risks are, the default risk, the credit risk, the interest rate risk, and all the various risks. Correct.
Yeah. So it would be like a better decision, like to know exactly what there are risks taken by what kind of assets.
Correct.
Um, yeah, I'll go to next one. That's for Joe.
Hmm.
Private credit funds in real estate sector often struggle with cost management and transparency. Does this mean that it's better to avoid these investments?
That's one way to look at it. But I would argue that to avoid the entire market would be a disservice to someone as an investor, but more importantly, a disservice if I were an advisor to my clients. My clients pay me to understand the market and advise appropriately. Yes, it can be an opaque market, but with appropriate due diligence, by speaking to the fund manager, by understanding the strategy, by asking good questions, by looking at their track record, by understanding the team. These are all the various what I would call intelligence or pit bits or parts of the puzzle that we can put together to form a view. A form of view, yes, um, it might be opaque on some of the underlying investments, but if you have comfort on the manager's ability, the manager's professionalism, and this will go some way, I think, to provide some comfort to invest. And I did go through some of the things to look at, the track record, look at the size of the team, look that it is appropriately diversified. You should look at funds that have um, many underlying loans and loans maybe in different sectors with different underlying borrowers so that you're not exposed to any particular risk.
Yes, that's true. There's also always some common ways to actually check the
Mm-hmm.
fund manager's qualities behind
Mm.
those investments. Um, let's go the next one. That's from Li Hua. Says, do you think it's a good time to invest in bonds in today's high interest rate market environment, or should we wait for the interest rate to go down?
Um, I would say it's always a good time to invest in bonds. It's just the returns are different.
Oh, okay. So, so
Yeah,
you think
I'll
it's
continue. I'll explain a bit further. Just
yeah.
as something popped on the screen. Yeah, just that the returns are different. What I'm trying to get at is this. Bonds have a role to play in portfolios from an advisor's or investor's point of view. They provide some capital stability and capital preservation to an extent. And that's always an important consideration as part of a portfolio and also the regular income generation. Whether interest rates are higher or lower, capital preservation and stability of portfolios are still important. Yes, income may fluctuate, but that's just a reflection of the general interest rate environment.
Okay, next question is very similar to this one, but I think it's
Hmm.
very interesting. I think a lot of people actually will have this kind of question. That's
Hmm.
from Maggie. Says, my
Yes.
question is similar to Li Hua. In the current high interest rate environment, should we keep money in the mortgage offset account or allocate a portion to other fixed income investment. That's like
Ah,
A or B.
ah, um, this is I think, more an advice question rather than an investment question, because it really depends on each individual's circumstances and objectives. Um, in general terms, an offset account provides a guaranteed return, and obviously that's very attractive in a high interest rate environment like now. In contrast, or the alternative would be if a client does have excess funds, then private credit might be something to consider. And let me maybe elaborate on that a bit further as well. I mean, again, this is more advice, and so it's just general comments rather. I mean, if you look at a client that has, a mortgage, outstanding mortgage, and an offset account, we know that placing funds in offset account provides a risk-free return, firstly, and more importantly, it's a tax-free return as well. Whereas investing in private credit will provide a pre-tax return. So tax needs to be considered as well. So once you do the math and the calculations, an offset account sometimes becomes relatively attractive for some of these reasons I just mentioned.
Right. It's a
Mm.
really tricky
Mhm.
question. But yeah, by talking that like everything we say here is a general advice, but
Mhm.
literally this is very everybody's question nowadays. So it's
Correct.
very interesting. And last question is from Mickey, saying lots of news from the star
Hmm.
environment this year. What does mean to equity investors and debt investors?
Great question. Yeah, Star is very topical. Headlines every day for the last couple of weeks. And let me bring up the capital structure again. In Star's case, my understanding, there's just broadly two things. There's shares right at the bottom and senior secured debt right at the top. There's nothing in between. So straight away, we can see that the priority of payments starts from the top. The senior secured debt gets paid first, and then the shareholders. On the opposite way, the risk of loss applies to the shares first from the bottom up. So again, back to the principles that I discussed earlier. If you read the news articles, I would say that there's been talk of a possible voluntary administration of Star as one of the options that the company might take. And in that scenario, if you take that further, if it goes into administration and a liquidator is then appointed, then this capital structure comes into play. Then it would be a look at the balance sheet. What are the assets and what are the assets that can make good or make repayments on the senior secured debt? I hope that answers the question, Mickey. I think that was a great question. Very topical.
Yeah, very good question.
Yeah, I think he did
Um,
ask something. If he buys the shares now, what did he say?
yeah, she followed with a question saying, does this mean if I buy Star shares now, this will go to debt facility pay debt holders? That is the concern.
Ah, okay. I think we need to understand how the secondary market works. When we trade shares on the ASX, it is a secondary market. We are buying shares from another shareholder. We are not buying shares from Star. Star does not get your money when you buy shares on the ASX. You're buying off another shareholder. In other
You
words,
have
it does not.
6 million.
Yeah. So I think that answers your question, Mickey. It does not go towards repaying the debt.
Right. I got another question from someone anonymous saying, what are the fundamental difference between ASX listed private credit funds and non-listed credit funds?
In this instance, you are referring to the access. How can an investor access the fund or investment, right? There are many examples of private credit investments that are both ASX listed as well as unlisted as a managed fund. They could be identical. It's just the access or how you purchase or invest is different. And again, you'll need to look at the structure. Again, it becomes very technical. If it is a LIT, listed investment trust, that is very different from a ETF managed fund that's listed on the ASX. I'm going to be a bit technical here. An ETF managed fund listed on the ASX generally trades in line with the underlying NTA of the managed fund. So moves in line. So that provides you with certainty when you buy and sell. In contrast, a listed investment trust can trade at a premium or discount to the NTA. And this is an additional risk as an investor if you do purchase on the ASX because of the uncertainty of the trading price when you buy or sell. If you look at the PDS of any listed private credit fund, they will explain this risk as well.
Right. And also, is the unlisted credit funds still available to those non-wholesale clients?
Correct. There are managed funds that are for retail investors, which invest in the private credit space. Correct.
Yeah.
There are a few reputable managers, in our view, that are available to retail investors.
So some of them may provide both listed and unlisted and with similar features,
Correct.
which yeah, we need to identify. Oh, sorry, the retail investors need to identify from that.
Correct. Correct.
I think that's all the questions.
Okay, that's great. Well, so firstly, I'd like to thank everyone for the fantastic questions. It shows, I think, great participation by the audience and and the attention over the last 1.5 hours. So in summary, for today's presentation, we discussed 3 areas. First, the difference between debt and equity investments. Second, traditional fixed income investments such as corporate bonds and government bonds. Third, contemporary fixed income investments, including private credit. In the post-GFC era, fixed income investments have evolved to a greater role for non-bank lenders. Fixed income investment opportunities have broadened significantly. Investors now have a greater choice to invest in assets that generate an income stream. We believe that portfolios have to evolve with the new investment opportunities available. These opportunities can provide greater diversification and different ways to generate a sustainable income stream for portfolios. So I wish to thank the CPA and Wendy for the invitation to present today, and also to thank all of CPA members and guests that are attending today. It has been a privilege to present to you. It has been a good session, and thank you for staying with us to the end of the session. It has been a long evening, and I appreciate your attendance. And back to you, Wendy.
Thank you, Sia. It is my honor to actually have you invited and come here to give this fantastic topic and all the conversation. And just on that, I see Zoe put your hands up. Is there anything you want to talk about? Okay, so maybe a mistake. And thank you everyone for this. And I do want to remind everyone that after this session, I will send out email to all the attendees today. And I will, in the email, there will be a link of the recording of today's conversation. So you can always refer to it if you want. And second is that there will be a slides and there will be, can we go to the next page, Sian? So you will see all the contacts with both me and Xian, so everyone can have access. If you have any questions, follow-ups, anything, Xian's always there. He's a very experienced financial advisor. You can ask him any questions. I'm pretty sure he will be happy to answer. And also, there will be CPD points. There will be 2 points for this session. But we do need to remind, thank you everyone for staying so far. There's a keyword for today's session. I will give it a red because that's also symbolized New Palma, the color red. So after this session, I will send out email to you guys with like a link for the CPD points. So you need to put your name onto it, which you want to show on your CPD points on the certificate, as well as the keyword of red. And yeah, that would be everything. And after this session, we will have another session in the next month. I will send out all the notification newsletters to you guys lately. Yeah, thank you.
Thanks everyone for attending.
Thanks, everyone. This will be the end of the session. Thank you. Bye.